Looked at the stock market this Friday morning. We're going to open, well, ever so slightly higher, pretty flat basically. But look at that. That's the yield on the 10-year Treasury. That yield, the interest rate on it, is way, way down. Why is that? Because the world is terribly worried about Deutsche Bank and the European banking crisis. They're piling into U.S. Treasury bonds. It's a safe haven, and that's bringing our interest rates down. Deutsche Bank at the moment is going to open ever so slightly higher. But the real question is the trouble at Deutsche going to spread to other banks, maybe in Europe, maybe around the world? Look who's here. Our favorite market watcher, even though he's a permanent bear on the market. Yeah, you are. Jeff Sica is here. All right, let's deal with this European banking crisis. You think it's a serious crisis, do you?
Oh, this is extremely serious. And what investors have to realize, and what makes it serious in comparing it with Lehman Brothers did not have the extent of retail depositors. Deutsche Bank has about $300 billion in retail depositors, about $500 billion on deposit. If in fact there is a run on these assets, that creates a very serious situation in Europe.
Oh, so that's
and around the world.
300 billion there. I mean, could the bank actually use those deposits to bail itself out? That would be a terrible sign, wouldn't it?
Yes, and one of the most desperate things that a bank could do is what's called a bail-in, which means that those depositors could essentially be affected. And if there's even speculation on that, if they don't do something drastic to save this institution, the possibility of a run on assets is always there.
And we've been showing bank stocks from around the world, actually, all of them terrible chart going straight down. But I've got to ask you to deal with this. Janet Yellen, in this conference call, in a videotape conference call with the Kansas City Fed, said, look, if we were to buy stocks and corporate bonds, that might help in a downturn. That's revolutionary.
It's revolutionary, desperate, and if anyone doesn't think that this Fed is desperate and delusional, that specific example should be proof. Japan did it. They decided that they were going to go and they were going to buy stock, and it didn't help household spending, and it didn't even support the stock market. So Janet Yellen has gotten to the bottom of the barrel when it comes to what she's going to do to try to artificially prop up this market. I think it's a mistake, and I think if she keeps talking about it with no rational follow-up, there is going to be major, major issues.
Look, I've got to move on real fast, but I have to ask you, are we looking at the likelihood of a serious big-time bailout for European banks?
There has to be. I mean, the European Central Bank has got to get involved. We have a lot of issues when it comes to the #1 factor, which is liquidity.
Okay, but if we got that bailout, if they get that bailout, our stock market goes up, doesn't it?
Well, yeah, because, you know, here's what's happened. In 2008, too big to fail, we bailed out the banks. Europe's going to have to do it to some extent now. And if investors see this as being a positive, that now these central banks around the world are backstopping these banks, investors are probably going to celebrate. When you have a headline that says that one of the biggest banks in the world is about to collapse or is on the verge of collapse and the market rallies, what is that telling you?
It tells you a lot.
Yes.
Jeff Sica, stay there. Want you for the opening bell shortly. Thank you.